Good afternoon, everyone, and thank you for joining us for today's conversation on how CDFIs can build a more resilient balance sheet. My name is Jessel Amin, and I'm a senior commercial banker in the Community Development Banking Group at JPMorgan Chase. I work in our intermediaries lending line of business, which includes our firm's lending activity to CDFI clients. Over the last 20 years, JPMorgan has invested over $2 billion in CDFIs. And in this seat, I have the pleasure of screening the financials of many CDFIs and having lots of conversations with CDFI practitioners about the challenges they're facing. So from my perspective as a lender to CDFIs, as a board member of a CDFI, and formerly as a member of the finance team of a CDFI, there's something that has stood out to me as a strength for CDFIs. And this was really the impetus for this panel discussion. And that is CDFIs with a resilient and adaptive balance sheet and a really thoughtful decision-making framework are better equipped to navigate the turbulence of today's capital raising environment. And it's my observation that CDFIs of all sizes can proactively recognize vulnerabilities and take the necessary measures to build resilience and mitigate risk. Through the lens of our three esteemed panelists, who are CFOs representing diverse organizations, this session will explore the leading practices to build a balance sheet that can withstand market stress and strategically pursue new opportunities. Panelists will discuss what metrics they use to identify risk and how they measure their organization's financial health. They'll share tactical solutions for increasing capital productivity through more effective liquidity management, and they'll explore strategies for building internal policies and procedures that promote better decision-making. The format of the session will be 40 minutes of moderated Q&A, and then we'll move into a live audience Q&A session. So please feel free to submit your questions through the question chat function, and we can get started. So I'd like to start with each of the panelists introducing themselves and then answering our first question, which is, what does it mean to have a resilient balance sheet? So we'll start with you, Matt.
Yeah, thanks, Jessel, and good afternoon, everyone. And thank you, Jessel, for leading this session on this very important and timely topic. So my name is Matt Gladding, and I'm the CFO at NeighborWorks Capital. We primarily lend to the 250 nonprofit members of the NeighborWorks America network. And to date, we've provided over $500 million in capital. Recently, we've begun to add additional business lines to complement our lending function. For example, we set up a consulting business. I've been with the organization for 1 year, but I've been part of the CDFI and community development field for approximately 15 years. To your question on what it means to have a resilient balance sheet, I'd like to take the high-level view that having a resilient balance sheet means that you have flexibility and that you're able to make choices. You have the ability to absorb market shocks and events and adjust to the needs of your borrowers and customers. But it also means that you're not one bad event away from being unable to perform under your corporate agreements or that you're in breach of financial covenants. In essence, you want to have a diversified business model and a high level of operating self-sufficiency. Two, a well-matched balance sheet with ample access to liquidity. And then lastly, policies and procedures, a solid team culture, and depth and breadth of your staff. I believe that the first point I made on operating self-sufficiency will garner more importance in this market environment as rates have risen and margins are being compressed. I'm lucky that NeighborWorks Capital has a solid financial foundation with a resilient balance sheet, but we have to be focused to successfully manage through this market environment.
Great, thank you, Matt. Arif?
Thank you, Jessel, and as Matt mentioned, thank you for leading this session. This is extremely critical, especially the environment that we are in. I'm Arif Rizvi. I'm the Community Housing Capital CFO. CSC, as it's the short form for us, is like Matt mentioned, we are an exclusively NeighborWorks network organization, the capital corporations, and we work exclusively with 250 NeighborWorks organizations providing exclusively in the affordable housing sector. We provide single-family, multifamily construction loans, and also technical assistance to those seeking financing. Matt has mentioned the resilient balance sheet aspects, and I'm not going to repeat it, but to me, it is again a combination of healthy capital ratios, liquidity ratios. It reflects an appropriate amount of debt in the balance sheet. In other words, organization has enough bandwidth to operate under stressful environment. And still, this is very critical and still stands the scrutiny of various shareholders. And why does one want the balance sheet to be resilient? Is because we want to continue pursue business opportunities and comply with the mission. And the byproduct of having a resilient balance sheet is that the first thing that an investor looks into is your balance sheet. And it just helps for the investor forming a favorable opinion about the organization. Thank you.
Yeah, and Gasper?
Hi, I'm Gasper Magallanes. I'm the CFO for Working Solutions CDFI. We are a micro enterprise and emerging small business lender out in California, serving 19 counties in and around the Northern California Bay Area. I'm really pleased to say we just crossed the $50 million all-time deployment threshold. Slightly smaller number than some of the numbers that I heard from Matt and RF, but definitely very impactful, and we're super proud. I joined the organization in 2021, so I've had a couple years now with the organization, but prior to that, I was a lender to CDFIs for an impact investing firm, and then before that, a career in financial services. Yeah, I think Matt and Arif really hit the nail on the head on what makes a balance sheet resilient. Maybe to make a finer point on it, or maybe just kind of contextualize that, at least for me as a micro enterprise and small business lender, one thing that I'm looking at on a day-to-day basis is that classification of my balance sheet. We've kind of alluded to that already in the form of your asset to liability mix. I'm really looking for that favorable asset to liability mix, so that I know at a basic level I have enough cash inflow coming in from the loans that I've made to be able to service the debt that I've obligated myself at least in the next 12 months. So that's certainly something that's top of mind for me. I'll also say, just as a final comment on this, because I haven't heard anybody mention it, certainly allowances for loan losses and loan loss reserves, two really important aspects of your balance sheet, and I might just note two very different aspects of your balance sheet are super critical, and making sure that those are kind of reflected within your financial position.
Great, thank you for sharing that context, and I'm looking forward to sort of digging into some of these subtopics. Can each of you share with us what metrics you use to identify and measure your organization's financial health? Matt, maybe we'll start with you again.
Okay, thanks, Jessel. So we recently began to utilize an internal dashboard with over 50 metrics. And these metrics include, so on top, we show our financial covenants. And this is also to create visibility across the organization for what those are, followed by all the other internal KPIs. And we can dig deeper into all those specific metrics during the Q&A following this panel. But on a higher level, our covenants include leverage, liquidity, secure debt, profitability, and portfolio performance. And the remaining KPIs cover everything from capitalization, so the amount of our undrawn available capital, the weighted average cost of capital, to asset liability matching, as well as operational metrics such as the number of FTEs and open positions. And the thought behind this is that it will help us spot trends, but also identify areas for us to take a closer look if something seems off. And we want this to generate questions and not just answers. For example, do we have sufficient undrawn available capital to meet commitments? Or if our weighted average cost of capital is increasing, which it currently is, let's take a closer look at what is happening to our yield on our new loan deployment. Are we selling more participations, or are we growing our balance sheet portfolio, and so forth? Again, happy to chat more during the Q&A afterwards and in more detail about all those ratios.
Great. Thank you, Matt. And Arif, how about for you? What are some of the metrics that are important to you and that you're sort of monitoring on a regular basis?
Thanks. Before I mention the metrics, I just wanted to say one thing, and that is we at CSC, we implemented a complete enterprise risk matrix. The objective here to implement that was to ensure that all potential risks are mentioned in that matrix, and we grade them from high, medium, and low. Now, low risk is something that we can always live with. High risk is where our attention is generally diverted to. As Matt mentioned, there are a lot of metrics that are there, but this question is about the financial metrics. So what we've done is we have classified those metrics under capital ratios, earnings, asset quality, liquidity, and impact. Benchmarks against these metrics are basically depending on what your business plan says, what your covenants with the investors are. For example, a capital ratio of 20% is industry standard, but your business plan might have a 25% for that. Current ratio 1.1 is the minimum, 1.5 is preferable. Earned income is another critical ratio for us where it shows whether revenue diversification is warranted or needed, or what are the opportunities. The bottom line in implementing these metrics is basically to ensure what I said when the question was on what resiliency means to me, is to continue to able to operate on the mission that we have. And these metrics become extremely critical to, for us to keep on that path.
Great, thank you. And Gasper, could you share with us sort of your perspective as a small business lender, sort of similarities or differences in the types of metrics that you're thinking about?
Sure. The good news is that there's a lot of similarities, and so a lot of what folks have already kind of flagged is or stuff that you would find in our dashboards and our tracking. We primarily, our North Star tends to be liquidity, having a high deployment ratio, definitely self-sufficiency and earned income ratios. We're primarily a micro enterprise lender. Small business lending has become an emerging part of our portfolio. So the work is quite expensive and the margins are quite tight. So self-sufficiency is always going to be kind of top of mind for us, as a primarily micro enterprise lender. And that's kind of seen in the market as well for a lot of other micro enterprise lenders. I will say, in as much as it's important to have the metrics, it's also, equally important to have like an ability to track yourself against the metrics and compare yourself to peers. And I'm not a plant, I was not put up to do this by OFN, but I just want to call out their side-by-side report. It's extremely helpful that as you are kind of setting your own kind of benchmarks and kind of tracking your own performance against these metrics, to be able to see where your peers are performing, and not only your peer organizations that are doing the type of lending that you're doing, but at the scale of lending, that segmentation that you would find in that side-by-side report that just came out. Always a little bit dated, but still extremely helpful. So quick shout out to them. And if you're a CFO or a finance person and you're not, leveraging that tool source, you need to start doing that immediately. It's a really great treasure trove of information. So.
Thank you for sharing that tip. So next, I want to sort of slightly change directions. There are many sort of macroeconomic headwinds that CDFIs need to consider when they're thinking about developing a more resilient balance sheet. For this purpose of this conversation, let's sort of zoom in on the sort of hot topic, which is sort of the current interest rate environment. Can you share how your organization is navigating the high interest rate environment and sort of share some advice on how to be opportunistic in this market? So maybe Gasper, we'll start with you for this kind of question.
Sure. Yeah, I think the higher interest rates, I think, is top of mind for everybody. And I think for a lot of folks, it might be a scary time to consider growing as an organization. I think for us as a micro enterprise lender, we have no choice but to grow. We have to continue to grow. And so we've been able to look at this head on and try to figure out what are the ways that we're going to avoid some of that incoming compression on our spread, on our interest spread, or margin spread, that we haven't quite seen yet, but that we know will come at some point, particularly as we start thinking through our deployment strategy over the next 1, 2, and 5 years. One thing that I think that we've been able to do in a quite opportunistic way is leverage the secondary market. And so the secondary market is not going to be something that's accessible to every single type of lender or type of lending. And, it's a little bit of an interesting space for micro enterprise and small business lending because These are usually not transactions that are highly collateralized. They're not secure. Most of the time, it's unsecured lending. But we've been fortunate to connect with a number of different intermediary CDFIs and organizations that have really helped to unlock this type of lending. And what that has done in the short term is it's allowed me as the finance leader of the organization to be able to kick the can down the road a little bit on taking more debt. And so my estimate is I've effectively held off on taking at least $3 to $3.5 million of debt that I would have otherwise taken on at today's interest rates, and instead I've been able to keep my cost of capital, weighted cost of capital at just a little over 2%. Which, when I started that a year ago, I was like, oh, this is coming. I'm going to start forecasting, margin compression, and because my interest rate is going to go up. And fortunately, we've been able to keep that low, which has also allowed us to move our interest rates for borrowers at a much lower pace than the evolution of rates in the capital markets. I think the other big thing that's been really helpful for us, and again, it's going to be specific to the different circumstances, is really large boons in net assets. And so we were fortunate to be one of the big recipients of the ERP grant through the CDFI fund this past year, $4 million that we were able to go ahead and deploy. And effectively, as of today, and we received the money in October, I think we've deployed pretty much all of it at this point. I'd have to check my loan servicing platform to confirm that, but that has been a strategic, a strategic advantage that we've leveraged really to our benefit, and has helped to kind of push the need for taking on higher cost of capital for the future.
Great, thank you for sharing that perspective and that sort of experience that you've had. Arif, how about for you, how are you guys navigating this interest rate environment? What are some of the challenges and opportunities that you're facing?
Sure. I would begin by saying that an organization will continue to face headwinds, okay, and that is just the nature of the business, and that's how we need to navigate. In the current environment, the interest rate is a pretty significant risk in terms of where we have seen the pre-COVID days from 0% interest to 5% and so forth today. I'll give an example of what we did in CSC. When I joined CSC in 2019, we had 85% of our capital was variable capital to a bank syndicate. And it was at that time very low. But one thing that was very clear in my head was that this is not going to remain. And what we started doing at that time was, trying to raise fixed rate, longer term capital. What I was envisioning at that time was, even if the interest rate goes high, we can use a blended finance concept and still continue to service our clients. And that strategy helped a lot. I did look into derivative tools where I can use a swap mechanism to offset the high cost. But those instruments for CDFIs turn out to be very expensive and a little bit more hard and complicated to implement. Gasper just mentioned about the importance of net assets and grants. These go ahead again to reduce your cost of capital. And by implementing these measures, what we achieved was 90% of our loan portfolio is below market loans, which is very significant because as we continue to implement a vision and mission, the cost of capital again and the spreads become of paramount importance. In this current rate environment, it is better to rely on a blended rate of finance. You will always need the ability of having variable capital that is not drawn at the moment, but the ability to draw down, which will primarily be your growth capital. But again, managing it at a blended level is what I'm trying to say here is very critical.
Great, thank you. And Matt, do you have more to add to this conversation around interest rate market?
Sure. I think that's all we're talking about these days. So let me give you some high-level data points before going into some of our balance sheet strategies. So we've seen significant market events over the last 1 to 2 years. I'm sure everyone has heard of Silicon Valley Bank, First Republic Bank. Also, let's not forget that SOFR has increased from effectively 0 to over 5%. And all of this has had an impact on the CDFI landscape. With respect to NeighborWorks Capital, the bank failures saw our quarterly loan requests, which historically hovered in the $15 to $50 million range. We saw those spike to over $143 million in the second quarter of 2023 alone, as many medium-sized banks stepped back their lending activities. So we could not fill that gap ourselves. And some of those loans were done with other CDFI participants, while other loans just didn't get done. And that is not even to speak about pricing, just looking at pure lending capacity and requests that came in. We are a fixed rate lender, and we rely on fixed rate debt to fund our balance sheet. And as of year-end 2023, we have fully drawn all the available fixed rate debt. And many bank investors continue to provide floating rate lines of credit. And at NeighborWorks Capital, we had over $60 million available and undrawn at year-end 2023. But with those lines of credit being priced at over 7%, if I'm looking at where our loan portfolio yield is, this is not where we want to be. And I've heard from many other CFOs that finding competitively priced medium to long term, fixed rate capital is a significant challenge. Now, banks and Chesil, don't worry, we will always need access to lines of credit since we make commitments to our borrowers. So those were nearly $40 million at year-end 2023, and we want to have access to lines of credits from banks to be able to fund those commitments. Where we are strategically is, so it's possible that we could see some Fed rate cuts this year, but elevated rates are likely here to stay. So we as CFOs, we must ensure that our assets and liabilities are well matched and also well priced. As a mission-driven lender, we may see some margin compression, but we're also working on structuring facilities that can enable us to raise capital at scale and raise that capital more efficiently. So for example, historically, we may have worked with many different investors on getting 3 to 5 million in new commitments. But if we want to leverage our balance sheet by an additional 50 to 100 million, we can physically do it in $3 to $5 million increments at a time. So we need to be more efficient going forward. To that end, we pursued an S&P rating to be able to issue bonds, and we also joined the Federal Home Loan Bank in Atlanta. And as we scale, I think that is where the opportunity lies in us scaling and becoming more efficient in our capitalization strategy, even if we see some margin compression on the portfolio side.
And Jessel, can I add a few things to Matt's point, please? So, Matt, we are all discussing about interest rates, and I would just like to mention, the economic headwinds also is an opportunity, okay? And I think, when the environment becomes very speculative and you don't know what's going to happen, I think engaging with peer group is very, very critical. I think Matt mentioned the OFN side-by-side report. Gaspar mentioned and Matt mentioned about S&P and Fitch ratings. These rating agencies have a paper on which they write about what is going to happen in the next quarter. And that is extremely helpful. And really, when we do our treasury reporting or the ALCO meetings to discuss what the environment would be. Because the interest rate environment, I'm going to reiterate what Matt said, higher interest rate environment is there to stay for the time being, okay? And unless we get ahead of it, there will always be compression on spreads, which would, hamper our ability to continue to do our mission.
All right, I think you stole the words right out of my mouth, because that's what I was going to say in terms of the headwinds are also like an opportunity in disguise. For me, two things. One is, and Matt, you alluded to this is really an introspective opportunity to look at your finances and become more efficient. And certainly you can gain efficiencies by scaling the organization. But I think there's nothing like some additional drag on your P&L coming from the cost of capital for you to start thinking and reprioritizing your line items in your budget and kind of rethinking how you approach the work. And certainly at Working Solutions, we find ourselves, day in, day out thinking, how can we do the work that is more scalable, that it's very, hands-on work, but how can we not lose that touch, but at the same time do this, at some sort of savings. The other opportunity is, I think, the opportunity to collaborate with others, quite frankly. We saw that, I think, as a sector during the pandemic, that there were many opportunities to collaborate with other organizations, CDFIs, other community harbor master organizations. And I think that opportunity is even more present now with the interest rate environment, because it's not just our respective organizations that are feeling the pain of cost of capital increases. It's everyone. Everybody's feeling this. And so we're all trying to figure out how do we kind of get the work done in a new and innovative way. And I think that one of the blessings, if you will, of this is it's going to open up the door to a lot of other conversations that might not have happened but for some of this like existential pressure coming from interest rates. So,
because at the end of the day, I'm a firm believer that money should never have been free. Okay, we were used to free money, and that is, that is something that became a challenge later.
Thank you all for this rich conversation. What I'm hearing is that this is the new normal and that we need to find sort of creative and opportunistic ways to sort of play in this new normal space that we're living in. So sort of moving slightly directions to sort of thinking more about the tactical, can you guys share with us sort of what are some of the policies and procedures and frameworks that you've implemented to be able to better manage liquidity and to help promote better decision-making at an organizational level? So Arif, maybe we'll start with you on this one.
Sure. Different organizations use different tools. Managing liquidity, which promotes decision-making, is extremely critical. Now, I joined CHC 5 years back, and I knew immediately, at that time, we did not have a dedicated treasury reporting tool. And I immediately knew at that time that this is going to be critical. So what I did was I implemented a dashboard called treasury reporting. The intention in implementing this dashboard was to enable us to take quick decisions, but more importantly, timely decisions. This dashboard incorporates the whole suite of treasury services, treasury reporting, like current spread, calculations compared to budgeted, interest rate sensitivity analysis, including projection of the spread for the fiscal year, asset liability mismatch purely on a cash basis. Then I also do a sensitivity analysis of the loan portfolio, fixed versus variable, given the pipeline deals and the calculation of the yield. This is obviously linked to the interest rate sensitivity analysis. Cash flow projections, taking into account fundings and repayments. These are the tools that we use to price a loan which is in the pipeline. Remember, I mentioned earlier, 90% of a loan portfolio is below market financing. One of the things that I also have come to a firm belief is that none of these things has much value if it is not fully engaged with the board. So the finance committee at our level, we have a detailed discussion on these metrics, which is very helpful in understanding the current market. We get the board's perspective. We see what decisions we need to take. Where I'm going with this is that this reporting tool is so critical in today's environment because you need to continue to do lending, which is your mission. And secondly, you need to be sustainable, self-sufficiency, and all that is baked into this treasury reporting because it is basically the DNA of the organization, and you need to have a control on that.
Great, thank you. And Matt, how about for you guys? What are some of the policies and procedures and frameworks that you all have implemented?
So I think we love policies and procedures on the finance side, but I maybe want to highlight two spreadsheets that I look at frequently when I think about liquidity and asset liability matching. First, on a quarterly basis, we prepare an asset liability matching spreadsheet that shows all balance sheet items on the y-axis, and then the next 10 years on the x-axis. and it provides a great visual of our total balance sheet, and we can easily identify overall mismatches. So for us right now, we are all of our liabilities are fixed rate, and we're a fixed rate lender. So we're overall well matched in terms of floating versus fixed rate debt. I think the challenge now is as we raise new capital at significantly higher rates, we need to ensure that new loan portfolio deployment keeps up with that higher rate environment. And then separately, we have a bi-weekly meeting with the portfolio management team where we review an updated loan portfolio funding forecast model. And this model includes all the loan commitments. I had mentioned that the 40 million at year-end 2023, new loan deployment, loan extensions, and so forth. But it also incorporates our capital side. So meaning our debt and equity to cover any shortfall. And that allows us to uncover any shortfalls and areas where we perhaps need to have a conversation on how to manage a specific issue. It's also helpful to have visibility into the yields on our loan portfolio and how that compares to our cost of capital. In terms of policies and frameworks, what we do is similar to other CDFIs. One area to highlight may be that we have a separate definition for operating cash and lending cash, and that last year we began investing idle cash into treasuries. So at the end of the year, we actually had a much higher cash level than in prior years, because we actually drew down a lot of our fixed rate debt before the availability for that debt expired, as opposed to not drawing down that debt and then being solely reliant on floating rate lines of credit. And then, those were all the internal frameworks. In addition to those internal policies, I had mentioned S&P, and we also joined the Federal Home Loan Bank Atlanta. And there are additional ratios that are important to those external entities. At the moment, we're working on building those ratios into our management seamlessly. For example, there are 4 ratios with the Federal Home Loan Bank. And as we're aligning covenants with our investors, we are incorporating those so that we can reduce the amount of operational effort and noise to be able to focus on what actually matters. Thanks, Jessel. I think this is a great question for where we are these days.
Yeah, thank you, Matt, for all that, those sort of nuggets of information. I'm sure there's lots to unpack there. So if we want to go deeper into any of those, we can do that in the live Q&A section. But Jasper, how about for you? What are some of the sort of frameworks and policies and procedures that you've been thinking about?
Well, definitely one, maybe not a policy or procedure, but certainly a new practice. And Matt touched on this. That as an organization, we finally had an opportunity to do something with idle cash. For many years as an organization, there was virtually no yield that we could generate on idle cash, unless you wanted to kind of lock money in for much longer terms and kind of do that analysis in any event. The nice thing about what has kind of happened in the past year, both with interest rate environments, as yields have increased, obviously, but also we use this as an opportunity to diversify where we keep our deposits as well. As we were looking at some of the bank failures, we wanted to make sure that we were covered as much as possible through the FDIC insurance, and so we were able to piggyback our deposits off of the IntraFi network, and it's a network service that a number of banks use or leverage to help support their deposit clients. Matt and RF, they shared a lot of good, hard tactical things that, in terms of policies and procedures and frameworks. I just want to go back to the, just at a basic level, the value of a finance committee. During this time, it's really important that you don't have a committee that's just kind of a rubber stamp. Make sure you have folks on that committee that actually you value their opinion on the topics. And that they bring insight to the work. I recently got a really great recommendation to run a particular type of sensitivity analysis on the cost of capital and what that would do to margins, and then ultimately how that might trigger a covenant. To be honest, that was not top of mind for me, but somebody put that in my head, and I said, "Oh, that is a really smart thing." And so I think there is an underutilized opportunity through finance committees, and most of us have them. And if you don't have one, or you're not kind of meeting regularly during this time, use this as a clarion, if you will, to start leveraging that group. The other thing is, it can be kind of lonely sometimes as the CFO of an organization. You are in a really kind of interesting position because you are trying to, certainly you're trying to help accelerate and improve kind of the operations and the gains of the organization. And to some, you may also be the person that has to say no a lot of the times, or kind of you maybe be a little bit more negative about some of the risks that present themselves. I've found, though, that having a really good executive team has been super helpful, but also having a great unofficial mentor and kind of bench of colleagues that you can reach out to is really super helpful. And so I'll give a little shout out to one of my mentors, Christina Travers, who happens to be one of the CFOs, the CFO of LISC, and was actually one of the plenary speakers, or she was the plenary moderator. But I also love the fact that I've got these great relationships with other CFOs and finance managers and business managers in and around California doing the type of lending that I'm doing, or different types of lending, and I can really learn from them and incorporate their practices. Even this exercise of getting together and talking about this session with Matt and RF, like now I've got an even more extensive network, and really appreciate even some of the little tidbits that I've learned from you guys through this. So really, hands down, those have been really helpful for me as I've been looking to manage my own liquidity and make better decision making during this time.
Yeah, thank you, Gasper, for elevating that point. I think it's such an important one that there's tons of expertise in the room here, but also with peers within the industry, and there's a willingness for us to learn and to grow together for sort of a centralized mission that we're all trying to do to sort of, increase the work of CDFIs in our communities. And so folks should take advantage of that when they can, and taking advantage of sort of expertise within the field that can exist as sort of members of your board as well. So thank you for lifting up those two important pieces. So to round out our conversation, I'd like to pose my final question for this group, which is really around how do you as a CFO think about growth? And how do you think about the sort of trade-off of growth versus profitability, or growth versus self-sufficiency, or growth versus impact? I think, Gasper, you elevated this point of, sometimes as a CFO, you have to be the person to say no, and it's because you're sort of really tightly thinking about these levers. So talk to us around sort of how you manage this part of the conversation. And Arif, we'll start with you.
Thanks, Joseph. I think this is a great question, and it summarizes, and rightly so, the last question, because it summarizes what we've been talking about. My perspective is as follows. I think all is interlinked and not mutually exclusive. And let me explain what I mean by this. We have all heard about the accounting concept of a going concern. The auditor primarily audits the balance sheet based on that concept. What it means is that the organization is expected to continue to perform. Now, for a going concern concept, it is essential to grow, to be sustainable, to create the impact that an organization exists for. Let us unpack this a little bit more. Organization can only be sustainable if it continues on a growth trajectory. Being status quo is no longer an option at all. Given the means to grow is finite, the planning is required. This is where profitability comes in, because otherwise growth will not be sustainable. At times, one has to value growth over profitability, but not as a strategy. Self-sufficiency is critical because first, the means are limited, and investors who are primary source of capital, including foundations, do not much value a non-self-sustaining organization for now. Impact is where mission comes in, and this is where we remind ourselves who we are and what we do. At CSC, for the last 5 years, we have been delicately balancing this. For example, self-sufficiency ratio has been 100%. more than 100%. Loan portfolio has grown by 34%. 70% of our loans are below areas of AMI 60%, and more than 90% of our loan portfolio is below market pricing. It has been, I have to confess, it has been very difficult. It is a tough thing to do. But at the end of the day, we reminded ourselves every day that we need to continue to do our mission and continue to do it more in a sustainable manner. This is what I mean by it is not mutually exclusive. Thank you.
Thank you. And Matt?
So NeighborWorks Capital, as an organization, we place a high value on self-sufficiency, and similar to CHC, so we have an 80% self-sufficiency goal with NeighborWorks America, but over the last 10 years, we've achieved a 110% average self-sufficiency. So in other words, we have not had to rely on grants to pay our expenses in the past. However, we are now in a different market environment, and it's also important to diversify revenue streams and engage new investors and efficiently scale your balance sheet. And those costs for new business ventures can initially have a negative effect on your profitability. I would also say that the solid financial foundation gives you the flexibility to work with borrowers if there are issues with specific loans or structures. And lastly, impact versus self-sufficiency. Impact can happen because of the underlying profitability, but we shouldn't be self-sufficient at the expense of innovation.
Great, thank you, Matt. And Gasper, any concluding remarks for this question as well?
Well, I think you guys just did a great job of just kind of summarizing. I mean, it's really, they're all connected in a lot of different ways, and it's a very nuanced conversation. What I would say is, just as an example, you could be impactful, but you're not growing or profitable or even self-sufficient, right? So there are scenarios where some of these things are going to be potentially mutually exclusive. But I think ultimately, if you are focused on growing, then you're going to have some focus on profitability at some point, because how else will you grow? How else will you grow your net assets? And I know certainly as an organization, in order for my own organization, Working Solutions, to say, hey, we're going to deploy 10, 20, 30, 40 million over the next few years, that's not all going to come from net assets. That's going to have to likely come from borrowed funds. And surprise, I'm going to actually have to still grow my net assets to be able to generate, enough equity to leverage. So I think, being able to kind of keep an eye on that profitability and what is the motivation behind it. Self-sufficiency is absolutely going to follow with that as well, because you could still be profitable, but not self-sufficient. Philanthropic dollars are going to be carrying more weight. But again, I think I don't want to preach to the choir here. I think we all recognize that, just because your budget's in the black doesn't mean, everything is hunky-dory, right? There's still opportunities to improve. The last thing I would say about impact is we are in a really interesting seat. Again, I said this earlier, as CFOs, what we consider to be impactful may look different from different kind of seats in the house, so to speak. And I think just reminding ourselves that the impact is not, you can't always reduce impact necessarily to financial measures or indicators or outcomes. It's really got to be a comprehensive picture. And so I would say, impact, if you were trying to think about impact as a CFO, you might think about, outcomes related to cost effectiveness, but just recognize that's not the end all be all. This is a very nuanced conversation and consideration for an organization.
Great, and thank you for those concluding remarks, because I think that sort of leaves us in a nice place that I think this sort of really disciplined and rigorous, nimble management of the balance sheet actually allows us to be more impactful and sort of have a long-term sustainability to be around to be doing this work. So thank you. Unfortunately, it is time to sort of wrap up the moderated part of the discussion. This conversation has been incredibly rich, and I feel like we're just sort of starting and peeling back the onion. And so I'm looking forward to inviting all of you into the live audience Q&A, where we will be continuing the conversation. So we will see you there in a couple of seconds. Thank you.